Preparing to live stream. This meeting is being live streamed. Okay, welcome in. This is our Chit Chat Money Investing Power Hour. For those of you that are watching live, I gotta silence this real quick. For those of you that are watching live, feel free to get some questions into the chat. But the only rule for this is no rules, really. Anything goes. We're supposed to come with no prep. Usually we have Ian on, but today it's just Brett and I, and we can talk about anything, whether that's macro, micro, really anything. And am I forgetting anything?
Nope, it's just going to be us two for the time being.
We're looking for a
Ian has
third.
to Ian has to retire. We're fielding some prospects right now. No, we haven't really done anything in that regard, but yeah, hopefully, we get some more people on here in the not so distant future. Anything that you've been looking at this week that's piqued your interest?
Um, I read through Chewy's earnings report the other day, and it kind of just got me like pessimistic about the market as a whole. And it was actually like a decent report, but it made me think like they pretty much hit their revenue line. Like active customers was down quarter over quarter. So their active customers declined, but their revenue was up pretty strongly because of price increases. And it just kind of got me thinking about how inflation is like this self-reinforcing thing where they can increase prices, consumers have to pay more. And then I think, well, how do the consumers pay more? They get higher wage increases. And then that's a higher expense for the companies, and the companies have to raise prices again in order to pay those expenses. And it just becomes this like horrible cycle. And I don't know, it just got me thinking like, how do you stop it once it gets going?
You got to cause a recession. It's a brutal, right? That's the only way.
Is that the solution? You just raise rates to like you pull a Paul Volcker and just raise rates to whatever the inflation rate is?
Yeah, well, it's a really difficult question. I don't think anyone knows the answer because there haven't been that many of these scenarios in modern history. So it's not like anything statistically significant. How many periods have we had? Like post World War One, post World War Two, 70s. That's like three examples there. So it's hard to get a good read, but I think the only conclusion you can draw is that it it's hard to put back the genie in the bottle. And if there's a good way to do that, that's $1 trillion. Like if there's a good way to do that, where like 100% of the time you do this as a, say, fiscal policy person, working at the Treasury, working at the Fed. If you do that and it works, then I mean that you've solved a lot of the world's problems. But I don't think anyone has a foolproof answer except for blunt forcing a recession, which is never fun. That's doesn't have all positives to it.
So what happens in a blunt force recession? Just bankruptcies, essentially, like a greater amount of business failures.
I'm not sure. You're asking the wrong guy. I think that is way out of my depth.
I imagine unemployment goes up, and I imagine a lot of companies fail because financing is too costly. That's kind of what maybe that's first order thinking, but
Yeah, and then hopefully people hope that consumer spending might go down. But the thing is, wages are way more sticky, so it's kind of if um hmm. So I guess the whole thing is if prices don't keep inflating and maybe there's some disinflation or consumer spending's down, blah blah blah, wages at a lot of companies are not going to revert back. If say there's some deflation or something like that, which I guess has been rare, but if there is any deflation, that just can be tough on margins for companies because wages are tougher to revert back, or really basically impossible because no one's going to say, yeah, I'm going to go back from $100,000 to $80,000 now that CPI is down. But yeah,
but
either way, I don't
if the
know.
alternative is unemployment, I think you will.
Well, it's really hard. Historically, companies have not been able to do that. But we'll see. Who knows? Who knows?
Yeah. Anyway, that was just like It's been like reading the earnings reports has made me just bearish all week. Um, I don't know. It feels like every company is not performing optimally.
Yeah, we've talked about margins before, margins for like the broad margins for the S&P 500 or the market indices. And I've been kind of the camp that there has been a secular growth because of since the start of the internet, that in, broad-based profit margins. And you've seen that in the charts, except for in the recession of 2000 and the recession of 2008. And a lot of people have said that they're going to revert back to the long-term trend of, say, 6%, which what it was, I think, is what it was in the 20th century. And I've been kind of the camp that doesn't make sense given the different unit economics of a lot of these firms. But I think if there's a heavy inflationary environment and a recession, we how am I trying to say this? We could revert back, but I still think if you look at the long-term charts, in the 0809 recession, margins went down. In the 2000, 2001, 2002 recession, margins went down, but then they reverted back to that long-term trend. So I'm still optimistic that this is only going to be in the short term, and that the secular growth and margins will stay there just because of the unit economics of a lot of basically FANG and a lot of those software stocks. But it's hard to tell. It's a really it's really difficult, and I don't have any sort of conviction one way or the other.
Yeah. What about you? Have you looked at anything interesting this week?
I was reading the OpenSea fraud security. I don't think it's technically securities fraud, but someone that worked at OpenSea, I believe a product manager, would buy NFTs before they were about to get launched onto the homepage and then flip them after they got bid up, because when NFTs were hot, you put something on OpenSea's homepage and the price is going to soar. And there was conviction on that for insider trading on these NFTs. So I think that's a positive to get some of that, bad actors out of there. But it's also funny that that's what people are going after. If you kind of get what I mean, that seems like a kind of small thing, and isn't the whole thing that a lot of it's just really fake kind of gambling stuff anyways. So what's the point? But besides that, earnings have been pretty quiet along our neck of the woods. It's software. This week is kind of software week, right? The first week of that, of the second month in the quarter is always software week. And to be honest, it's pretty boring to me. But I've been reading some stuff on nuclear energy, which doesn't really pertain to investing that much.
That does. In the end,
yeah, the uranium prices. I've heard people give good pitches on that. There's a good chart. Here's an interesting one, though. I'm kind of just going through my likes on Twitter, which is fake prep, I guess, for the show. And there was this chart that I don't know whether it's a chart crime or pretty glaring about how a lot of the NASDAQ companies can't fulfill a lot of their interest expense. So the chart is called the zombification of the NASDAQ, and it is the NASDAQ composite EBIT divided by interest expense, and is the percentage of firms. And it has basically, if your EBIT to interest expense is greater than 10, 5 to 10, 2 to 5, 1 to 2, 0 to 1, or less than 0. And I think it is 70% are less than 0, which at first you're like, okay, what?
Repeat the metrics. Sorry.
EBIT,
what is it?
EBIT divided by interest expense. So how much your annual EBIT can you use to fulfill your interest expense on your debt? Does that make sense?
Yeah. Okay.
Basically one of the metrics to fulfill your debt. And 70% have an EBIT to interest expense less than 0, which means they have interest expense to pay and have a negative EBIT or negative operating income. Now, at first glance, I thought this was pretty bad, but on second thought, given the heavy SBC at a lot of these companies, I don't think the problem a lot of the time is um, paying off debt because they have the cash there. They're just paying for it through the dilution and SBC. I know that might just be companies we've looked at personally, but does that make sense to you how this might be overstated in this chart? Just because EBIT, while is probably a good metric for people to use to value the profitability of these companies, it's not really on the cash flow basis of any sort of liquidity concerns.
Yeah, I mean, if you're looking at a giant pool of software companies, you'd probably want to do like cash generation before interest expense over however much their interest is, since they use stock so much in their compensation.
Yeah, that makes more sense to me. An operating cash flow or a free cash flow, even if the free cash flow
Because
is
they're not
technically
going
fake,
to, if
but-
they're, I mean, if they're getting cash in the door that exceeds their interest expense that allows them to pay it, like the likelihood of bankruptcy is lower than the EBIT might indicate.
No, yeah, I agree. Like EBIT, I don't think is the right metric for any sort of liquidity scenario, or I don't know if liquidity is the right word. The margin of safety of whether someone's going to go bankrupt without raising money, needing to raise money.
Unless and we've talked about this before, unless your employees stop taking stock.
Yeah, or stop wanting to. Although I did see something that maybe we'll get to later. Yeah.
Oh, actually,
right.
I have a question for you. We're talking about Carvana tomorrow, and in Carvana's recent report, the CEO is paying out $100 million of his own stock to employees. He's like gifting it to them. What do you think of that? Because it gets recorded as SBC, but it's non-dilutive.
Yeah, that was yeah, that one's a unique scenario. Just the merits of that, I liked. There was a lot of governance concerns with Carvana, which I think anyone that knows Carvana is well aware of. And as someone that's doing the management and ownership part of that, or I guess, but we're both probably looking at that, it was a tough to understand all that stuff, and I still don't think I get it yet. But yeah, that part specifically seemed like a nice positive, because yeah, just gifting the shares, I kind of like that. In general, even though Carvana, there's a lot of governance share type stuff that seems a little dirty or tricky. But yeah, in general, that strategy seems good.
If you've issued, I guess I haven't looked at the proxies, so I haven't looked at his compensation package. But if he has been issued a whole bunch of shares and then he's just gifting them back to the employees, it's almost like it's dilutive SBC anyways, because it's almost like you're just paying them directly, but you just instead are giving it to yourself first.
Yeah, you may have seen my tweet. So
the total shares outstanding, that's up like 10x in the last.
Yeah, I was gonna do a quiz for you, but let's see what it was. 5 years ago in July 2017, it was at 15 million. And today it is at 105 million shares outstanding. So yeah, they're financing through shares, share issuance, even though that seems nice, gifting the shares to the employees. It's not a negative at all.
It's
I
crazy.
don't think you can say that this is a friendly to outside shareholders when it comes to dilution.
It is crazy that they have raised that much money through stock issuance and are still having liquidity issues.
Inventory, that's tough, managing that inventory.
You were given, I don't know, they were given basically a golden hand. Like, you got pocket aces. Like, there would have been no better environment for you to raise capital in than the last 10 years. You got the chance to do it, and now we're still left potentially with a bankrupt company. I don't think we've gotten far enough to know whether or not it's true, but they obviously have a lot of debt as well, or an interest that they have to pay.
Yeah, it's an example to me of why I don't like companies that have the need to manage a lot of inventory. I'd rather have a company that just doesn't have any inventory. So I
Cash
think
flow is
that's just
nice.
Yeah, in general, that's a negative to me. And it's why I think it's important. Personally, when I'm looking at a company for something that has, as best as you can describe, a permanent working capital advantage. Three examples that come to mind: Amazon, the classic one. They were financing a lot of their growth through the permanent working capital advantage. Spotify, Airbnb, who are some other ones? Yeah, but
Netflix.
I'd much rather have that, where
Does
Amazon
Netflix
has
do it?
Sorry,
Does Netflix count?
I don't think so.
I feel like any
in that
subscription
regard.
business where you're taking it up front.
Yeah, and in Amazon's, it's not. Wasn't. It was a mix. Well, I guess the Prime was some of it too, but a lot of it was people would pay for a product and then they wouldn't pay their merchants for 90 days, or they pay them every month or something like that. So that gives them that advantage to manage growth. Yeah, but either way. All right, here's another. I'm going through my like tweets from Preferred Shares, and he asked, what is the ideal number of stocks for a concentrated portfolio that represents 100% of an investor's net worth? What do you think? What's your answer there?
Yeah, I saw that one and I kind of thought about it for a while. 100% of your worth. I don't think you could go less than 10.
Yeah, I saw a lot
I
of
would say
people go less than
99% of people should not go less than 10.
I wouldn't go less than 10. I
And
feel
now, if one of those 10 is an index or an ETF, you're fine.
no. I think the rules were no indexes, no holding co's. So
Yeah, you
no
can't go less than
Berkshires.
10.
I would go 10 to 20, kind of depending on what your style is. I think is a good mix, and it really depends on whether you're. I think a key difference is whether you're always rebalancing. To say if you had 20, you're always rebalancing to 5%, or letting some run and maybe something that's a huge winner turning into 50% of your portfolio. I think that's a key difference as well. Also, if you're unrestricted from any artificial stuff, that is also a key. But I think that was part of the assumption here, where if you're younger and you have an unlimited time horizon and no outside capital, that's, I think 10 to 20, more than 20, honestly, would be unideal, because too many things to manage. And you're already going, if you have 20 stocks, as long as they're not in the same industry, as long as you don't own 20 oil companies or energy companies, you're already getting the majority of the benefits of diversification. And you're actually probably going to have not a good, like you're going to have a negative effect from having too many companies. Do you think, speaking on that,
equal weighted.
Yeah. We got to get a comment here on your, I think, complaints here from Eric. He said it's all good. GDP is going to accelerate to 30 to 50% a year. Thank you for the joke there. I think that's going to be a classic joke from the ARK Invest projections there. But here's my question.
That is, you know what, that would solve, my portfolio. But here's the contingency. She doesn't say whether it's real GDP growth or not.
She's an inflation truther. Yeah, she's going to.
So if it is pure inflation, she could be right, I suppose.
She's going to start dividing things by the Fed's balance sheet. We're going to start seeing that there. But here's my question. Do you think a lot of investors get into trouble or hurt themselves by owning too many companies?
No. Well, they might not get the optimal performance that they could, but I would rather see, like, the average investor, even if I'm the average investor, let's say, it's a better safeguard than being too concentrated. Like, if you're choosing between too diversified and too concentrated, I would say pick too diversified.
Well, that's not the question isn't whether someone's going to be too concentrated. The question is, do a lot of people hurt themselves by owning too many companies? Because I see people that own 50 companies, and I kind of think that's just not, it's just too much.
I mean, if they're all equal weighted, I don't know. It's basically the index, right? Assuming that they're like in different industries, I say go crazy. Who cares at that point if you're basically the index?
Yeah, but that's
more,
the point.
Okay,
What's
more
the point
fun.
then?
It's more fun than the index.
It is more fun, but
because you can feel like you have a winner on any day.
well, but that's not a positive. That's you know what I mean? It's just nice
I don't
for
know.
people to
You
feel.
own, let's say you own a basket of 50 stocks and you like investing, you like the process of it. 50 good companies that are hopefully index components and you think could be I mean, but honestly, that is more risky than the index because those could all fail and the index could do really well.
Right, right. You have to monitor those. Yeah. And I think there's a difference between a huge difference between equal weighted and having some stocks being a giant portion of your portfolio, where a lot of people love to do the tracking stocks. Not really my style, but a lot of people love to do a tracking stock where they just have one share or a small amount. So I think that's a big difference. If you have 5 stocks that are 50% of your portfolio and then 30 others, that's definitely still concentrated.
Yeah. All right. I actually liked Eric's comment. So let's go a little deeper. What did you think of the claim?
Well, it's ridiculous. I mean, Pat, right? Isn't it?
I
There's
mean,
no.
you don't believe in innovation.
Let me run some compound. Let me just get the compound interest calculator going out here on the old Google. Let's put some numbers to back this up. All right. So let's see. Let's go to the low end, 30%. Right? No, that's a bad calculator. Okay. Nerd wallet. Help me out here. All right, perfect. Let's say initial deposit. We're basically pretending this is GDP is it's just an investment account. So say let's just pretend it's 20 trillion. I think it's like 100 trillion, but let's just do 20. No annual contributions. And we're going to compound annually, right? Investment time horizon, 10 years. So basically we're going to say we're
I
going to
think
say
she said for
what GDP will grow over 10 years. Oh, come on, load. Nerd wallet. Don't do this to me.
dude, it's like so like life can only get so much better. Like,
oh, there we go. Okay, 10 years and then estimated rate of return 30%. I think that would be it. Compound annually. Future balance. If we started out with
30 to
100 bucks,
50, keep in mind. So let's take the median or the middle.
I'm doing, I'm doing 30% or do you want to do 40? 40? Okay. That's their base case.
Yeah.
All right. We're saying world GDP is 100 trillion, right? And then we're going to do 10 years later, growing at GDP at 40%. It would be $1,379 trillion world GDP. So divide that by world population, which is what, 7.7 billion?
Yeah, it might be higher.
I mean, people we don't even need to do the math there. Everyone would be absurdly wealthy in real terms.
But it's relative. Like wealth is relative. Like if the population's the same, our lives didn't get. It'll always be. If you're a trillionaire and everyone else around you is a quadrillionaire, no one cares that you're a trillionaire.
Well, no,
it doesn't. Your purchasing power hasn't actually changed, I assume.
No, well, I think you're just doing comparatives. You're saying that in your scenario, you're saying inflation is running rampant because if there's real GDP growth, that means that everyone is absurdly wealthy and basically living the life of someone that, everyone's like what 100 millionaire, a centimillionaire is living today.
I know, but I don't think there's that much room for like improvement of life.
Oh, well, yeah, of course.
I mean, how much better can it get?
On that, well, on a long enough time horizon.
Like our resources are finite.
Yeah, on a long enough time horizon, sure. But yeah, it's not going to be 40% a year.
I think Bill Brewster talked about it. The greatest GDP growth in a single year for the US was 1942.
And what was it?
Bombs and tanks.
I know. What was the number?
19%, I think was the number.
19? Oh yeah. Well, that was yeah. And that was a year where it was
if that's how we're getting 30% GDP growth, then
well, once we colonize Mars and
something tells me it's not sustainable.
Once we find aliens on Mars, we're gonna need to finance that war. right?
Yes. It's probably factored into their bull case
Yeah, I mean,
or
people.
their bear case.
I think, yeah, anyone just looking that doesn't, follow, I guess, the economics world, and they see 40%, it might not think that that's crazy compared to, say, 5%, a 5% prediction, but 40% over 10 years is, if that happens, I will give all, how about this? Let's make a bet. If that happens in 2032, I will give all my money to Kathy Wood. How about that?
Something tells me she won't be managing money by that point.
Hey, don't counter out. Hey, there's a lot of haters on it right now. All right, next, here's another topic. Call option trading among retail investors has fallen to the lowest levels since December 2019. So basically reversing all the surge in activity since the pandemic began. That's probably a good thing, right? For people just not trying to lose money.
Yeah, I think the casino's beginning to run out of entrants.
Mm-hmm.
We could even tell during the frenzy that call option activity was ridiculous. It was like the shoe shine boy indicator with all my friends that had never been involved. Like, I hear call options are the best way to go. It's like, dear God.
Who are they hearing this from? I think it's got to be the YouTube ads, right? Or the TikTok ads. I mean, how are people learning about this?
Okay, do you think the people that, let's take YouTube for example, I've got a feeling like 30% of their ad revenue was from crypto related ads.
Oh no, that's just,
maybe that was just hyper targeting for me, but it seemed like every single video was a Coinbase ad.
Well, I would say it's definitely not 30%. Maybe we subtract a zero there, and it's still a non-insignificant number.
I don't know. Don't you think they should be held accountable?
YouTube?
If you were letting, like, let's say, I don't know if Luna ever did this, but let's say Luna was being advertised on YouTube. Do you think they ought to be held accountable?
YouTube? Probably not. But
I guess they're just a digital real estate.
Yeah.
Digital billboards.
As a shareholder, I'd say vote no. All right. Here's another one. Netflix is going to stop greenlighting expensive vanity projects and start focusing on quality for their movies. What do you think of this move? I know everyone out there has a take on Netflix, but
yeah, I don't know. That seems like should have been the game plan from the start.
Yeah,
that's like an obvious hindsight thing, but I watched The Irishman.
I
think you and I may have watched it together actually, but
no,
or we watched The Departed or something.
No, we watched Extraction, which was solid. That was like 4 years ago.
Anyway, I had watched Departed and I got all excited for The Irishman. I think that was the two movies, and I was like, "Oh,
The Departed
it was terrible."
The Departed is not a Netflix movie, but yeah.
No, I know, I'm aware.
Okay,
but it got me excited for the type of movie that The Irishman would be.
Right, same director, yeah.
And yeah, it was trash.
Yeah, it wasn't very good, which is disappointing.
I do feel like they've just gone after whether it's. I mean, the Adam Project was okay, but they went after Ryan Reynolds. They've gone after Chris Hemsworth a lot for a lot of different movies. All these stacked casts with just no. It's like they pick the cast and then they're like, "All right, let's write a plot. Like, let's write a movie with these guys."
They had a good one. They had a good one about.
What's the best Netflix original movie?
The best one? Oh gosh, I forget the name, but Netflix German movie, World War II movie. What's it called? Munich Edge of War. That was actually really good.
It's the one where they have to like.
The guy almost kills Hitler. Yeah.
Yeah.
That one was really good.
I watched that one on the plane. That was pretty good.
Yeah. So I think they're getting better, but yeah, I don't know why this wasn't the strategy from the start. And I kind of think they're opening up an opportunity for HBO to, this is kind of their territory, quality over quantity.
Have you watched Obi-Wan?
No, don't subscribe to Disney Plus yet.
Okay.
Have you? Is it good?
I mean, I think I believe it was only the start. It was like two episodes that they released. It was okay. Disney's kind of pissing me off.
Yeah, they're ruining
They've missed
Star
big
Wars
on all of the Marvel movies since Endgame. And I don't know. Not to get too like political, but it seems very woke. Like they've really adopted that mantra.
Oh yeah. Well, that's not even that's just.
I don't know if that's like a better. Like if I were a shareholder, is that the better way to go? Really? Like, is there a bigger audience for that? Actually, like an honest question.
I haven't found that when watching stuff, but maybe some people don't like it. I just think they should focus on making it good.
It is. I mean, it's like watching the Obi-Wan. It's weird to me that you could be almost 40 years. Is it 40 years since the original Star Wars movies came out?
50, I think, probably 50 now.
Almost and you're
50.
Making almost lower quality movies.
Yeah,
like
they're
not only
nearly
the acting, but like, I mean, yeah, the graphics are obviously a little better, but
well, the stories
itself was so much. But this movie was so much better back then.
Yeah. The stories have been poor in my opinion. Interesting though. The video games have gotten a lot of praise though. A lot of the Star Wars video games. So maybe that's the way that they tell the best stories now.
I was about to say that. I do think
that's biased to our portfolio though.
Judging by my experience, and I know this isn't an EA game, but Lego Star Wars, incredible. I mean,
I heard that.
That's my favorite, probably, interaction with Star Wars content.
Yeah, and I was
like 12, but
yeah, that was a while ago. I mean, those Battlefront games were always good, and then now the story based ones, the Jedi. They made a new Jedi for that game that came out in 2019 from Respawn, and they got super great reviews, and now they're coming out with a new one in 2023. That seems there's just people love that story, and it seems like that's the most loved Star Wars story lately. And there's just been so much on not linear video that it's hard to.
We did get another comment from Achilles, who has been a regular viewer of the show. So always enjoy the questions. I believe we've corresponded via DM as well. He says, thoughts on REITs, data center REITs in particular. Do you have any thoughts?
Don't know much. Although we are nailing down an interview on, I think that's the same Twitter, EQIX, Equinix. We are nailing down an interview potentially in June. So hopefully we'll learn more. So stay tuned. And then what do we got this question on? Or do you have any thoughts on REITs?
I've been looking at some REITs recently. There was one that was an industrial REIT. So like selling to a lot of like e-commerce companies.
Warehouses, whatever.
Yeah, Amazon, like warehouses. Yeah. I like the durability of the businesses, but I think the opportunity cost now, I think there's better opportunities elsewhere now than, say, a year ago. I know that's obvious, but like I wouldn't want to be climbing into REITs when I feel like you can get a good return on other companies, like higher quality businesses.
Yeah, I think in general, anything real estate is just lower quality for me because I don't like the capital intensity.
There's also,
maybe I don't understand why it's a higher quality business. I know capital intensity can be great sometimes, but just for me, I don't like capital intensity. There's got to be something pretty special if you're going to be capital intensive. And maybe
Yeah.
there are REITs that aren't, but
And a data center REIT, like in theory, sounds incredible. I think Brookfield Asset Management, their infrastructure side they own a bunch of data centers and they haven't been performing very well. So
yeah,
it's not,
let me look at the old
I think
performance
there's more
chart for it.
complexities to it than just like, well, more people are going to use data centers over time.
Yeah, I think so. I believe that. And who has all the leverage there? I believe, AWS probably does. Well, Equinix, I mean, it's up the last 10 years at 447% total return. Hard to tell. I don't know much about them. Let's move on to this other question, which we might know a little bit more about because we just did one on Hershey. And thank you, Achilles, for that, saying that Adyen episode with mostly borrowed ideas was good. Not getting as much listenership as I thought, which is fine, but I think people really enjoy that. That was one of the best pitches we've ever had. So if you're listening to this, go back, listen to that. It's not even for us. We didn't say anything. He talked the whole time, which is great.
Sometimes after a good interview or like a good pitch, Brett and I kind of look at each other like,
that was good. Yeah.
Like we know that not only it was a good pitch, but like, maybe we got to keep that company on our radar. And it was, I'd say Adyen was in that bucket 100%.
Okay. Here's the question though. What is a reasonable valuation for staples like PG? Pretty sure that's Procter and Gamble. Low growth names like PG, Costco seem to be way overstretched at the minute. Or no, sorry. In my opinion, what kind of multiples make sense in your view? For me, it's got to be, well, there's some higher quality ones like Costco, but again, if it's lower growth, if something's going to be lower growth, this might sound crazy. Costco might be a little different, but if something's going to be lower growth, the earnings or cash flow multiples got to be close to 10, in my opinion.
I was thinking the same thing. Yeah. It's gotta be something where in 10 years, if the cash flow doesn't change, I'm getting a 10% return each year.
Yeah. And that's taking a little more risk, but teach his own. If you're okay, we just did a not so deep dive on Hershey. It's trading at, I think, about 20 times earnings now, which is a little higher than normal. It's similar to maybe a lot of these high quality CPG companies, but the growth is low. So do I think you would lose money over 10 years total return if you bought right now at Hershey? Most likely no, but there's a chance that you see some valuation compression. And I wouldn't want to take that risk for something that is lower growth. It just, that combination always deters me. There's so many stocks to invest in, but
if you're paying if there's risk of multiple compression at all, and I would say that tends to mean north of like, assumes earnings stability, it stays the exact same. If it's north of 15 times, I would say there's multiple compression risk
for a low growth. Yeah.
For low growth. If it's higher multiple, you should get paid to take that risk.
Yeah.
Which means traditionally that there should be a bunch of growth in its future.
Yeah. And sometimes that can come from margin expansion. So, if top line's not growing that quickly, if you have margin expansion plus a solid buyback program, but the thing is, the buybacks are so much more accretive at lower multiples. So if something's low growth and a heavy repurchaser, that's just so much. I mean, it's just math. It's so much better than a high multiple. Similar. Apple's the huge example of that.
What's the biggest green flag for a management team? Like, let's say you don't know the management team at all. You've never
heard anything they've said, never read or heard anything out of their mouths.
What's the biggest green flag that could happen? I have mine in my head because I saw one. I'll just say it. The one company issued like special dividends throughout its history. That to me is a green flag.
That's a good one.
You're giving capital back to shareholders when it's the right time to do it. And that's the only context I know of it. It could have been bad timing, but like you think it's good timing. It's not like you're putting it on the back burner.
Yeah, I think mine is an open repurchase plan with no limits. and a history of buying back intelligently.
Well, isn't that fun? The
Right? That's right. That's come on.
here's
That
an
makes sense.
yeah, I mean, definitely. But the open, I don't know. What if it's the open repurchase plan, but you're just repurchasing the same amount every quarter?
Oh yeah.
I'm
Well,
like,
I would say
you're like not thinking about it. I'm not a fan of that.
that's why I said intelligently. If you can, if someone's been if someone's been around for 20 years, whether they have been, there's enough data there to know whether they've been, buying back at opportunistically at the right times, if that makes sense.
All right, let me give a spiel on Apple real quick. My
Oh,
computer
wow.
died
Okay.
this morning. Computer died, crashed and burned. Don't know what's going on. Can't figure it out. I thought about it. I'm not. I don't like Apple that much. I kind of think of them as the evil empire because we own a whole bunch of companies that have to pay them fees, and it always frustrates me. But there's no way in hell I'm leaving that ecosystem for the rest of my life. The switching costs are too high. There's too much hours that I've put in, whether that's like files that are on the iCloud. Maybe there's a way to switch, but it just isn't worth the effort for
Oh,
me.
have you heard of a thing called a thumb drive and a Google account?
I mean, see, the Google account helps, but there's stuff that's like, I don't know. There's so much stuff on the computer that you'd have to go in and get.
Or just,
So many different files. You can't just.
but you can put them all. You just drag them all over. Maybe I need to help you out here.
Are you sure? Like all at once? Because what if I got to go into all these different areas to go find this stuff?
I think there's definitely a way.
And then I got to relearn over, I don't know, probably 2 or 3 months, the nuances of this new computer. And I'm slow with tech. I mean, I'm never going to leave.
Yeah.
I will say though,
Apples are way less intuitive than Windows, in my opinion, to learn like just where files go and how. It's just,
yeah, it's probably accurate. And I don't even care about the interconnectedness. I do with like the watch, which by the way, they're completely screwing Spotify on the watch. They're making it so painful to like.
Yeah, I think
download
I believe that's part of the lawsuit they have against them. Yeah, they create friction with them.
I don't know.
Well,
I thought
the
about it.
weakest,
Like, well, how big would the cost difference have to be for me to switch from go outside the ecosystem for my laptop? Had to be higher than it is now, I think.
well, as a Apple consumer, not someone that doesn't like them very much, I think you would be pleasantly surprised if you switched, but you can do whatever you want. I think the laptop or computer part is the weakest link. Would you agree or disagree in the Apple ecosystem?
The weakest link. Yeah, probably.
Still pretty strong though.
Yeah, it's not bad though. Like they're having MacBook shortages right now, I'm pretty sure. So it's, I don't know.
For anyone that's wondering, Ryan
It's a
has
utility company at this point. Like it's a utility. It's not, I would not call it consumer discretionary. I cannot work without it.
Yeah, but you can get a different brand. Yeah, I mean, yeah, I agree. The general category is, but yeah, I think there's the perception that people can't switch, but I don't think it's that big a deal. For anyone that's wondering, Ryan he's been working for the last 5 years on a 13-inch, 6-year-old Apple laptop. So we might get
it's put in a shift, no doubt about that.
We might get a whole new productivity out of Ryan once he switches to something with a real screen.
Hey, don't hate on the 13-inch. It's done wonders through university.
Okay. All right. Okay.
Yours is too big and clunky. I mean, it doesn't fit in most bags.
Hey, it fits in my backpack.
What were you gonna
Um,
say?
all right, here's another switching topics. This was a viral tweet, so I bet you saw it. But it's Lending Club says that 1/3 of consumers earning $250,000 or more annually currently live paycheck to paycheck, and these high income earners have an average FICO score of 758. Thoughts on that? Is the
One third.
American a
One
third?
third.
Yeah, is the American are people just well, obviously people are addicted to buying stuff, but this shouldn't, unless you have like 6 kids in New York City. I mean, this seems a bit ridiculous, right? People, how are we so immune to not saving money? Is that just kind of, does it feel strange to you?
I do feel like the generations before were so much more frugal than today's.
Hard to tell because we weren't living there, but most likely, yeah.
Yeah, I don't, I mean, it's absolutely ridiculous. You should not, yeah, unless you have a huge family and you live in a super expensive area, 250,000 should get just about anyone by.
And even like, say, going down, since we're both single and no kids, going down to, say, if it was just cut that in half to what, $120,000 a year to maybe X out those the other expenses, being generous with that, I would be, to live paycheck to paycheck, I would have to be spending so much money on stuff I didn't need. Right? Like how
Yeah.
much?
All right. Well, let's do the math, I guess, on the 250,000. How much do you get? We're assuming that's gross, right?
Oh, right. That's gross. So
So
net it
let's say
out
you get
down to
taxed. I don't know. Let's say you net
conservative.
150K.
Yeah, can go conservative. Yeah.
150K. You've got, what are your monthly expenses? Let's say you live in New York City and you're in a couple, just a
No,
couple.
New York's too outlier. New York's too outlier. Go like a suburb of Los Angeles.
Austin. How about that?
Okay, Austin's fair. That's fair.
Austin. Your rent, I have no idea what the rent looks like in Austin, but let's say it's 2 people. I'm going to assume 2,500.
If you're, yeah, sure, living comfortably, yeah.
How much is 150K a month in income? What, like 12K?
Sorry, what?
How much is
Oh,
150K
150 a
in
month.
income?
Let me just confirm it quick. Yeah, it would be like a little over
12 and a half.
12K. 150 divided by 12. Should be able to do this in my head, but
Yeah, I assume it's like 12 and a half.
yeah, something like that.
The
150
all right,
divided
so
by 12. 12 and a half. Yep, exactly 12 and a half. Good
two and a
math.
half gone after rent. And 2.5 might be a little, let's go ahead and say it's 3 grand. I don't know. Austin might be expensive.
Yeah, I mean, that would be a nice apartment for sure.
All right. Now you've got 9,000 left. Net of rent.
9,500.
9,500. How much are you spending on groceries? Let's say 1,000.
Yeah, but this is one person. So
Is it one person? Did they say one person?
1/3 of consumers earning 250K or more. So yeah. So this is like, what are you spending? I mean, this is being super conservative in that survey.
It's insane. Yeah, I think any way you cut it, like even if you spent $1,000 on groceries,
And $1,000 on restaurants.
$1,000 on restaurants,
Okay, you have like 150
$1,000
for
on
utility,
transportation.
150 on utilities plus Wi-Fi, and then probably another $100 for streaming or video games or whatever.
Pretty much any way you cut it, you're gonna have an extra 5 grand, I'd imagine.
What is everyone spending money on? That, I guess that's good for owners of
People-
financial
I
assets.
feel like
but
big spenders
man.
are probably listening to this. Like, what? Maybe we're too frugal.
Well, that's possible.
It is.
It's like, I always think of the moment in The Big Short when he's like, "Have you ever thought you were wrong, Dr. Barry?" And he's like, "I guess that's possible," because he couldn't. He never considered it, even though he was
Speaking of
right.
Burry, he was he was right again on the whole recession coming
Yeah, well,
or bear market, I guess. We are officially in a bear market, right?
NASDAQ, not S&P, did not reach it. Let me confirm that. The S&P got close, but never reached it.
It's what, 20% down? It's bear market.
Yeah, year to date, NASDAQ is down 21%, and that is after the recent rise. S&P is down 12.5% and got close, but did not get 20%.
But you got to do it from all-time highs.
Yeah, year to date is essentially all-time highs. We only had one day where, so that's kind of what I've been using just as a shorthand.
Damn, it feels worse.
Always feels worse. Yeah. Let's go. Any other topics? I think I scrolled by one.
Oh, you think Chipotle's quality's gotten worse? Are you short?
Oh yeah, these are all what all these comments are. Yeah. Thank you for everyone. Yeah, does that matter though? Like I just been noticing that their quality seems lower. Even like the employees say this might not seem like a big deal, but I think it is just for the customer experience. The building of the burrito or the bowl has gotten sloppy. And yeah, I don't have to shop there. Like that feels a bit pretentious, but it's part of the experience. If I wanted something that was laid out bad, I would just make that at home.
It does always feel, to me, it always feels like once a business starts making the in-store experience poor, it erodes that company's like longevity, even though like over the last year, I've walked into a Chipotle on multiple occasions and like they don't serve me and they're like working on all these online orders
yeah,
and they're waiting. That's like a huge, that's a big turnoff to me for Chipotle.
Well, I'm online. I never go. I'm online only. Get those points. Although I'm not going to use them anymore because I might be done shopping there, or getting food there. Like here's the deal with me. They're raising prices, right, to combat inflation. But you would have thought that they would stick with their high quality items, fresh, really fresh. And that was the whole thing. It tasted like something a fresh item you'd make at home for
you just think the ingredients are bad or what?
Yeah. And there's a lot of people this is Twitter without sources, but a lot of people saying that a lot of restaurants have done this now where they've had to get their quality of ingredients have gone down. Their sizes have gone down, and it's just because of these supply chain things, food costs, all that stuff. And they don't want margins to be hit. So, and they're having a tough time with labor. So a lot of the employees might not be as high as quality as they used to be. You know what I mean? If Chipotle is supposed to be the better and better for you fast casual, I think it's a mistake to go for these short-term margins because over the long term, they're just losing so much customer trust.
All right, let's say the supply chain shortages or problems persist, chip shortages persist, labor shortages persist, inflation's super high for the next 5 years. Where's the optimal place to be for your portfolio?
Oh, well, that's another $1 million question, right? I'm going to say this without putting much thought into it. Companies that live entirely digitally, right? With minimal employee needs. It's got to be it. You don't have impacts from energy costs.
Existing, I would add the caveat that you have to have like already high operating margins, because I think payroll is going to rise as a percentage of revenue.
Well, okay, then I will take a software or consumer internet company that is not impacted by energy prices and does not have much need for the lower end of the wage spectrum with positive operating margins. I think that's the ideal hunting ground because.
So Visa.
Oh, that's a good, yeah, something like that. I guess Visa is a great example. But you just my thing, I kind of invert the situation and say, okay, how do I avoid any impacts from oil prices or energy prices or commodity prices as best as I can? Or looking at a company, are they going to be able to avoid these, or does it matter to them? Are they going to be able to avoid wage inflation better than other companies? And if there's shortages in food, supply chain stuff, does that matter to them? I think that's kind of
I
the
think it
best
hits
hunting
every
ground.
company.
That's what?
I think it hits every company.
Well, second order
One way or
effect,
another.
sure. Sure. What about, well, I don't want
Maybe
to.
not. It doesn't hit every company equally, obviously, but I don't think any company's completely immune, other than literally maybe like MasterCard or Visa.
No, but they're not immune because of spending. If spending's down because people can't get stuff.
Yeah, but if inflation's up, spending's up.
Yeah, but if purchasing power is down,
Well, if purchasing power's down and inflation's up, then I think we've got bigger problems.
well,
Is that
ideal
even
hunting.
possible?
I still think I'm sticking with my answer. There are companies like that. I think there's companies in our portfolio that are like that.
I hope. I hope so. I hope you're right. All right, we've got like 2 minutes left. Any closing
Yeah.
thoughts?
Any
Closing
all the
arguments.
what
Closing arguments. What are we?
closing arguments?
What's the macro look like? What's your
It
macro
looks
take?
it looks confusing, and I don't really honestly, given the way we try to invest, I don't care, and I'm very comfortable because we try to make it. I mean, this is true. We explicitly try to make decisions, and this was before the macro stuff went all haywire, where macro doesn't matter. Like we try to, and I think that's kind of the way to do it. And to be honest, I don't really care. Here's one though. I saw a good interview with the guy that he's got the passive flow thesis. He's not the head of that, but he started that kind of thesis, Michael Green. And he made a great point that I think is kind of relative to if you're an investor trying to understand why markets are moving in, say, a certain week, or why they're up when a lot of the economic metrics seem bad. And so there's so much money in these passive, they're not even passive. It's just, say they're in a target date fund with 60-40 allocation. I'm sure it's more complicated than that. But in a month like May, when stocks were down a lot, your allocation of stocks are underweight what you want to be. So at the end of the month, there's a bunch of passive buyers from Vanguard, State Street. What are the other ones? Schwab,
Fidelity,
BlackRock, Fidelity, T. Rowe Price, that are buying up stocks in these 60-40 portfolios or whatever it is, index funds, blah, blah, blah. And they need to rebalance to get from, if they're down to say 55%, up to 60%. And that is just at a massive amount of flows coming in. And I kind of think, and this is without any evidence, and this is something outside of my league, that's what happened at the end of May. Does that make sense to you?
yeah.
All
I
right.
mean, it makes sense in theory to me. I'm not sure. I don't know if it's completely accurate, but like
Right.
that theory would make sense that all
Seems
these things are
plausible.
underweight. So what, they sell bonds? Let's say it's 60-40.
No, not necessarily sell bonds, but potentially, but
You'd have to, right? If you're 60-40.
yeah, I guess, but yeah, I don't know the exact dynamics. That's a good point. I think it's a plausible explanation though of what's happening.
Yeah, potentially. All right, 1:00. That's going to do it. If you tuned in, Achilles, Eric M, everyone who asked questions, thank you.
And tell the podcast listeners when they can watch live and join the few that are asking questions here.
Yeah, it's Thursdays at 3:00 Eastern time, 12:00 Pacific time. We are on then. Just go to YouTube, check out our page. And
next week's going to be Wednesday because I'm traveling on Thursday, but yeah.
All right. Well, next week's Wednesday, 12:00 Pacific time. I think that's going to do it. Do we throw disclosures on these?
Yeah, that's what I've been doing. Just
All
be
right.
safe.
Well, let's remind listeners that Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or recommendation. We are, however, general partners at Arch Capital. So clients may have positions in the securities discussed in this podcast. Thank you all for listening. We'll see you next time.